And thank you to the organisers, to Gersh and to Bart, for letting me sort of gate crash the session in a way. This is a session that I'd hoped to be able to attend. Then it looked like I wasn't going to be able to, and then as Gersh mentioned, luck had it that I was able to be here this week. And I'm really very happy to be here and to talk about something that I've been working on for a number of years with many people on the panel and in the room, which is what weather index insurance in Ethiopia, and what can we learn about how useful is this as a tool to help farmers manage the risk that they face, particularly the rainfall risk, the weather risk. Closer to the mic, okay. So I'm going to be, as Gersh mentioned, I'm at the World Bank now, but this presentation reflects the work that I was doing whilst at IFPRI, which is where I was until a few months ago, and over the last 4 years. So I thought it might be useful to start with sort of two contrasting views that seem to have emerged about weather index insurance as a tool to help farmers manage their risk. So there's the weather index insurance optimist. And for a long time, this was the only people that you heard talk about weather insurance. So everything you heard was very optimistic. So the weather insurance optimist believes that, well, as we all would believe, that managing agricultural risk in Ethiopia is very difficult, and it's difficult really for two reasons, because everybody in the same area gets affected by the same shock at once. So you need a financial product that finds a way of taking that risk out of an area. So savings or credit won't work very well. But it also needs to be a tool that can be robust to this problem of moral hazard that is very present in agriculture, which is that rainfall is just one thing that determines a farmer's yields. It's also a lot about effort, about the amount of time spent in the field, inputs used, so many other things. And as an insurer, it's very difficult to take on all of the responsibility for ensuring any yield loss that a farmer may face, because only some of it is as a result of this uncertain rainfall. And so the optimist would say that weather index insurance is a unique financial product that fits these needs, and it's the only realistic option for managing risk for rural farmers. And that not only that, but if only farmers had access to weather index insurance, that farmers would be able to, it would unleash investment opportunities for farmers. Farmers would be able to invest more in fertilizer, which has high returns, maybe risky returns, but they would be able to see substantial improvements in their lives, both as a result of the ability to manage risk, but also as a result of their ability to make investments that are subject to risk. However, there's also the weather insurance pessimists, and they've become a louder and louder voice over the years. They say weather index insurance, yes, it does have these characteristics, but it's essentially not really an insurance product. It's a hedging product, which means that it pays if based on rainfall recorded at a weather station that may or may not be related to the yield loss that a farmer has faced. And then there's a term that has become very prevalent in the weather index insurance world, which is the term basis risk. And as I'm the first presenter, I'll take a go at defining all these things, but imagine this is something that we might talk about quite a bit over the course of this session. But basis risk is the idea that even though you've bought insurance to insure you against the yield risk you face, the insurance is only going to insure you against part of the yield risk. It's only going to insure you against rainfall being low. And everything else, all the other risk in your yield is going to be left uninsured. So anything that comes as a result of crop losses is going, as a result of pests is going to be uninsured. Anything that comes as a result of maybe you experience a shock to your health, you're ill, you can't apply labor to your farm at the right time of year, that's going to be uninsured. So there's going to be many things that are uninsured. And furthermore, the weather risk that is insured is going to be insured in a very specific way. It's going to be insured by a measure of rainfall that is going to be measured at a weather station perhaps some 10 or 15 kilometers away from where your farm is. So it might not exactly represent the weather risk that you've faced. So because of this basis risk, it doesn't, the weather insurance pessimists would say, well, it doesn't really offer much value to farmers as an insurance product. And furthermore, we found out that as we've done these trials, that it can be very expensive. Weather insurance there's quite a high cost to having somebody bear this risk. And so because of basis risk, because it's expensive, demand is low. And actually, if anything, when weather insurance pessimist sees that some people are buying it, they would say, well, those people shouldn't really be buying it. And if they're buying it because they don't really understand the basis risk involved with the product. So the conclusion of the weather insurance pessimist would maybe be that there might be a role for weather indexes to ensure risks of financial institutions, such as an MFI that is offering loans to farmers, or it might be useful to ensure the risk of governments who are providing help to farmers in emergencies, or scaling up a safety net, such as the PSNP, to farmers when there's a drought. But it's not going to work as a standalone product that's sold to farmers. So what we've done in the last few years is we've tried it out. We've tried in a number of places in Ethiopia. A group of researchers at IFPRI and the University of Oxford have worked very closely with Busa Gonofa and Oromia Insurance to sell insurance to farmers in Oromia. And also, in the very first year, we worked with Nyala Insurance Company selling insurance in SNMPR. And as much as possible, we tried to be scientific. We tried to test out some of the hypotheses that we were hearing as to why weather index insurance may or may not work. The method that we used to do that was to, as much as possible, randomize what we did, if we could, and to use randomized control trial methods to learn from the process. But also there was a lot of learning that we did, just trying something everywhere 1 year and seeing what happens. And so I'm going to talk about I'm going to talk about the lessons from this, both from the experimental work that we did and also from the non-experimental results. So the first lesson that we have is that, this problem of basis risk really is a challenge to weather index insurance. We saw that we made a lot of effort training farmers before they purchased insurance. And in the first year that we were working with Busa Gonofa, we found that this issue of basis risk was a real concern to farmers. And farmers were not buying because of it. And some farmers that had bought wished they hadn't once they realized a bit more about basis risk. And so this was a long discussion having with farmers about, okay, well, how can we try and develop a product that has less basis risk? And we actually had a very unique setting in that we had rainfall data for many years. We also had data for farmers in these areas for many years because we were working in sites which had been part of a long-run IFPRI and Oxford and Addis Ababa University panel survey. So we actually had a sort of the ideal situation for designing a really good product. But still, however well designed the product was, there was still going to be some risk that was uninsured to farmers and was going to really reduce the value of this product. So what we did is in the second year, we introduced something called gap insurance, which was one way of managing basis risk, and I'll talk about another way of managing basis risk shortly. But gap insurance really did seem to help. When we had gap insurance in the second year, the farmers that hadn't bought in the first year were happy to buy. As farmers went through the process and they saw how gap insurance did and didn't work, they were still happy with it at the end of the process, even if it hadn't paid out. And basically what gap insurance does is it says, okay, we will take a weather index insurance, but we're going to have a very organized sort of redress mechanism. So if you observe that yields in general in your area are low, but the weather index insurance that you've purchased has not paid out, then get a petition of farmers, 50 farmers in your area that have bought the product, and have them sign it, and then we will do a crop cutting exercise in the area to get an estimate of your average yield. And if the average yield in the area is lower than a specified amount, then an insurance payout will be made. So it has a very well-organized redress mechanism, essentially, that still allows insurance payouts to be made if the weather index insurance doesn't pay out. The second lesson was that farmers are willing to spend on insurance. Even farmers many of the farmers in our areas, we had a variety of different sites that we were conducting the experiment with, and farmers were willing to spend. However, there were some lessons about this. One is that not everybody needs it. There was one area of the country where we were working where actually weather risk is not a major problem, and demand was consistently low in that site across years. We also had one site where it was a PSNP site. So you would think, well, this is a site where there's historic food insecurity, where food insecurity has traditionally been managed by public safety nets. Is there really a willingness of farmers to pay money in that case for a private safety net? And actually we found that farmers were willing to pay in that area, but that paying the full price of the insurance product was not really an option. So we tested this in a number of ways, but one thing that we did is we gave out different price discounts to farmers. We randomized price discounts. And that allows us to get a really good estimate of how demand changes with price. And we found that it really was very sensitive to the price, and demand was much higher at lower prices. And demand was really quite low when it was unsubsidized. So lesson 3 from this work was that selling through groups helps. So we, in all years that we did the weather index insurance research, we piloted selling through IDRs in the communities where we were working. Now, IDRs are, for those of you who are not Ethiopian, are traditional funeral groups set up to provide funeral insurance, and in many areas they have developed to provide also other forms of insurance to members in their area. And for what we observed through our work was that IDRs really played 2 roles. They made marketing weather index insurance much easier and cheaper because Busa Ganofa was able to coordinate with a leader of the IDR or some selected members of the IDR that could be trained fully, could pass on information about the product, and collect demand and premiums for the product. But there was a second very important role that IDRs played, which is that they helped ensure another aspect of basis risk that we weren't able to cover even with this gap insurance product. And this was basis risk that was would never show up in average yields at the village level. This was basis risk where an individual farmer experienced a loss much lower than everybody else in their community because of a specific shock that had happened to that individual. And what we found was that when we worked with groups to encourage them to share that type of agricultural risk within the IDR or within the group, that demand for index insurance increased substantially. So we saw at 29, you can look at this paper which sort of explains why we might see that effect and documents the effect that we see. But we saw that demand increased by 29% when this complementary informal insurance was encouraged at the same time as formal insurance was offered. So lessons 4 and 5 was that trust in the provider was very important. We found that in the first year of sales, there was one site where Busa Ganofa was a new site for them, was a new place for them to open up an office and start working, and that was a lot more challenging. Sales were more challenging in that area. And perhaps Teshomi will speak more about this in due course. We also found out that selling early is important. Perhaps the ideal time for selling insurance would be around the Meher harvest. Farmers have money at that time to spend. And also, it's really not fun to try and sell drought insurance when it's already raining. So it's good to try and sell insurance before some early rains arrive. So that would be another reason for selling early. And so moving on beyond what we learned about how to sell insurance, what did we learn about the impact of insurance? Does it hold this development potential that the optimists would suggest it does have? And we found, actually to our surprise, a really large impact on on input use for those farmers that had purchased insurance. Households with insurance were 13 percentage points more likely to use fertilizer, and that's off of an average rate of fertilizer use of about 50%. So there was a substantial increase in fertilizer use. And interestingly, that's consistent with other studies on weather index insurance. For example, a study in Ghana in a very different context has come up with almost an identical number. And studies in India have also, there's one study in India that also suggests that index insurance helps increase productive investments. And it's also very consistent with work that's been done in Ethiopia on the role of risk in limiting fertilizer investment. So it makes sense, but it was still surprising to see that it was this large effect. So at the end of these 4 years, perhaps, could we perhaps find a middle ground between the optimist and the pessimist, and suggest that when we design low basis risk insurance, and when we can find a way to subsidize it, and when we combine it with other approaches to managing risk, to managing idiosyncratic risk, then there is a high demand, and it will bring about increased investments for vulnerable households. But that the model of market-priced weather hedges sold as standalone products is probably unlikely to work and unlikely to meet the needs of Ethiopian farmers. So perhaps the conclusion is that selling index insurance to farmers in Ethiopia does make sense, but it definitely requires some kind of public support. So what kind of public support? Perhaps I'm going a bit more than what I should be speaking at this point, but some ideas that we can discuss during the discussion. There's been a lot of work done on how can insurance be subsidized in a smart way. There's a lot of stories of insurance being subsidized in a very bad way, but we're learning a bit more about how to subsidize it in a good way. One potential role for the government in Ethiopia might be to support the development and a capitalization of an Ethiopian risk pool among Ethiopian insurers. There's an incredible amount of variation in weather within Ethiopia, and that is risk that can be pooled quite cost effectively within the country. Secondly, for the reinsurance that does need to be purchased, for the risk that does need to be taken out of Ethiopia and sold on the international market, we've learned in a number of other contexts that subsidizing that purchase is quite an effective way of bringing the price of weather index insurance down. Also, there's a lot of large investment in farmer training, and farmers need to learn about this product partly just by buying it in early years and seeing how it works. So there's definitely a role for the government in terms of, or thinking about doing subsidies in the initial years, while that either be that in farmer training or be that in a voucher that allows a farmer to buy one unit of weather index insurance and see how it works. But that should be something that's very clear that it's being removed. So not a subsidy on the price, but perhaps about a voucher. And also, this issue of trust and developing good products is incredibly important. So investing in an ombudsman that does due diligence on the type of contracts that are being provided, and making sure that these redress mechanisms that need to be in place are in place. And finally, some suggestions for financial institutions from what we've learned, and Teshomi will speak much more to this than I possibly could, but just the importance of making sure that the products that are sold minimize basis risk, that it's perhaps worthwhile when starting to sell in areas where there's strong client demand for existing products, such as loans or savings. A good marketing strategy is essential, and working with local groups where appropriate, be that IDRs or cooperatives or other groups. And ideally developing other financial products to help farmers manage risk alongside index insurance, that it won't be a solution if it's sold as a standalone product. Thank you very much.